Thanks so much for tuning into Talking Point. I'm your host, Niraj Shah. Our guest today, Kenneth Andrade, founder and CIO, Old Bridge Mutual Fund. Kenneth, such a pleasure talking to you as always. Thanks for taking the time out.
Thanks for having me on the show, Niraj.
The pleasure is entirely mine, as you know it. Kenneth, let me start off by checking with you. How do you feel about the investing landscape currently, considering the fact that we're not cheap, but we are probably one of the few games in town, in addition to maybe South Korea and a few others, which are showing that promise of growth, and the macros don't look all that bad.
Um, so the environment's fairly robust still, right? And we are at a point in time where corporate utilization or capacity utilization is now very close to 90%, right? So the profitability growth of the broader market should be fairly healthy for this financial year also. So there are two parts of the market, two parts of the conversation. One is the economic condition and the corporate profitability. No arguments that we probably having a Goldilocks period. The second is how do we participate it, because finding pockets of value in this marketplace, they don't exist. So if you're looking for value in this marketplace, my simple recommendation is don't, because it doesn't exist. So it's a market where you will have to align with businesses where you think growth is there, and it's fairly obvious over the last into this 1 year where it will be. So I don't think you're going to have too much of disappointments coming up in this year. The problem remains is how valuations are, and how they trade. So I'm fairly bullish as far as the economic conditions are concerned, and as far as uh, where profitability is. I might be a little circumspect, on the other hand, on how to generate returns from this buoyant economy that's there.
Okay. Well, I have two or three follow-ups to that first answer itself, Kenneth. For the longest time, we've spoken. You've told me about how one of the facets of investing would be to look at companies which survive an adverse cycle, are leaders of the pack, and buy them at the bottom of that cycle turning around. Now, I heard you say that if one wants to look for value, don't. So my question is, for new money that might be coming into the schemes right now, how difficult is it for you to put that money to work? Where is it, or how is it that you are therefore zeroing down upon where to invest?
So let's put it this way: it's very hard to find an industry which is struggling. Everyone is profitable, everyone is generating cash flows. Some of these industries may not be at the peak of their entire cycle, but they're still generating this amount of cash flows. And I think any industry that is going through a corrective in this entire space, we are looking at them. I mean, to be frank, in the portfolio today, over the last couple of quarters, we haven't had a new inclusion into the portfolio for quite some time. So we stay with what you have, because this is what you know. There will be some businesses that are outside your portfolios which are doing well, and where you could put them on the radar. But I think you will get opportunities, maybe this year or maybe the next year sometime, to buy them at a fairly comfortable valuation. So in terms of executing what we have today, very few spots where there is trouble. But wherever there is, necessarily needs to be on the radar, because again, even those places are fairly well priced. They're not cheap. And wait for an opportunity. We've all seen multiple cycles, and there's never going to be a case where this market will not give you an opportunity to allocate fresh capital.
So that opportunity, Kenneth, comes in via a time correction or a price correction, or could be either, or would it come via an uptick in earnings that we might see in FY25? Because I also heard you say that the earnings cycle looks to be good for FY25.
FY25, we shouldn't have a problem. Like I said, I mean, most corporates that we engage with or have a conversation with, everyone's running at full steam, despite, I mean, um, so there is no challenge. And when you're having capacity utilization run at this level, profitability growth will start. And then you have the next capital creation cycle that will start, or capex cycle that will start. So the narrative is extremely strong.
Got it.
Okay, so there I don't doubt it at all.
Okay. So, okay. So then, where is the telltale sign and evidence of industries and captains of their industry or companies in that industry comfortable enough with the prospects to put up new capacities, Kenneth? We hear private capex in fits and droves, not across the board, but in select pockets. But what has impressed you the most in terms of companies which are putting up this capex based on the cycle view that you have of that particular sector?
I think everyone's doing it. Infrastructure is on a roll. Um, um, uh, in any industry which is linked to that business is doing reasonably well. We've got a very large exposure to pharmaceuticals, and that's businesses that are facing the international market. So basically, manufacturing pharmaceuticals, and they have a very robust pipeline that is there. Plus, profitability is also at its all-time high, and you've seen the back of capex out there. So that's the second place that we've seen. The chemical space, I think a lot of capex is already going on the ground, and in some cases, utilization levels have fallen off, and they've fallen off because new capacity is coming on. So I think over the course of the next two, maybe the next 3 years, they could rebound with a fairly strong cycle that is there. The automotive cycle, I think they're um, more from the ancillary part rather than OEMs. You could get a select few that will break out into the international space and do reasonably well with a reasonably large workflow. So I think these are isolated cases that are there, but the one that's got the maximum amount of momentum in terms of headline numbers or in terms of sales numbers continues to remain infrastructure, which is a very domestic business and very linked to government spends. I think that's probably the biggest sweet spot that the market has at this point in time.
Okay. Kenneth, the others we'll talk about on the other side of the break, but I'd love to dwell a bit on infrastructure since you kind of brought it up. I haven't usually seen you that constructive on infrastructure or that constructive on businesses which derive a large portion of their revenues from government contracts or where the ultimate paymaster is only the government. I mean, defense is that point. Maybe infrastructure may not exactly be that, but be that as it may. So, how tell us a bit about this. How do you view this infrastructure cycle? Why is it that you have that view? And what facets within this infrastructure could be the first amongst equals? Because there are many which feed into infrastructure and pure infrastructure creators as well. How do you play this cycle, therefore?
So if you cut across the value chain, there's the developer at the top end, and then there's a commodity basket at the bottom end, right? And companies are seeing profitability right through that entire value chain. So developers are bidding for larger projects, contractors are getting bigger pipelines of orders, and it's translating into a lot of commodity demand that's happening at the other extreme. And this is the workflow that is there at this point in time. So you will have to pick and choose where the sweet spot is to participate with this marketplace. So we've got a commodity basket, which we've spoken a couple of times in the last 1 year. We've got a few contractors, and the reason why we've got the contractors is basically they're now peaking at their margins, which are at their historical high. So we've come from distress about 2-3 years back to now peaking margins, which is at its all-time high, but the workflow is still there. So as long as you participate with the narrative, it's fine. I don't. I mean, if you ask me, am I putting a new position into play in the contracting business? No. In the commodity cycle, I think it still has probably some legs to go because you've got volume growths that are still fairly robust out there. And then the last part of it all is that the government in this cycle has been an extremely good client customer. Okay, compared to the previous cycle, the working capital cycles ballooned. This time around, it is much more manageable. The risk that is also there on most of these companies earlier was very centric on state governments. Now, most of the companies have been able to distribute their risk across multiple projects, multiple governments, and the size of these opportunities are significantly larger. So that's the context as you laid down. Obviously, the power market is extremely robust. That's where the developers are, and that's where all the capacity creation that is happening, which is also linked to infrastructure. So power capex is one of the largest legs of infrastructure. Is the largest piece of infrastructure creation on the ground. But when I put all of this in play, I've basically isolated two places that are there. One is the contractors, and second is the commodity market, where we feel there's an element of safety as far as the valuations are concerned. But the other part of the market, which is capital goods to a very large extent, seem to be pricing something that I would not be able to quantify or justify by aligning with some of these businesses out there. They trade like they are consumer non-cyclical businesses.
Yeah, they do, and the valuations are hefty. You reckon, Kenneth, before we take that break, you reckon that there is a case for, one of the reasons that was thrown around was that their moat around the technologies that they give and niche capex would have led to a lot of business there. Those are one of the many reasons. You reckon there is a case for a correction in the valuation multiples of some of these?
So as long as the narrative remains strong, I don't think the valuations will correct.
Okay. Fair call. Kenneth, stay on. We need to slip into a quick commercial break. We come back and try and talk about some of the other aspects that Kenneth Andrade highlighted. Pharmaceuticals and globally exposed pharmaceuticals, we talk about that. Chemicals, and we've seen that run coming in there. So try and probe a little bit about that, and a few others which are in news recently, maybe technology. Stay tuned. We'll be right back. Back with Talking Point in conversation with Kenneth Andrade, founder and CIO, Old Bridge Mutual Fund. Kenneth, something that the market seems to have gotten a little bit excited about is a return of IT prospects. And while the market ignored what Accenture did in the quarter, maybe it focused on the generative AI deals that it clocked in. And since then, since that point, I think Indian IT too has been rewarded. I would love to understand, how do you think about IT, because the concerns apparently are still there. So is the market bottom fishing? Is the market preempting something else? And how are you thinking about it?
Okay, I try to be a little specific here because when I look at our individual portfolio, which has got an element of IT in it, right? And these are large IT companies that are there. So when I break up the portfolio and look at businesses that are so tilting towards the large cap part of the entire segment, and then there's obviously a mid cap and a small cap part of the segment. A lot of IT businesses trade significantly low. Large IT businesses trade significantly lower than most of the other mid caps and large caps. So you've got a very solid business out there, which has got visibility, mature visibility out there, trading lower than the marketplace itself. So that's one element of why I think this sector trend has re-emerged. Because if I have to put incremental amount of money that's coming into the system, and I mean I, as in the industry, has to put incremental amount of money into the system, they will look at opportunities which have not done very well, have an element of valuation comfort on a relative scale to the marketplace, and then look for the element of growth. Now, if you go back a couple of years till today. And if you look at all IT services businesses, they've all been talking about and they've all been building up a robust pipeline of order book, which has not resulted in the element of execution that everyone was waiting for. So that is around the corner. Whether it was to come last year, whether it will come this year, some part of it will come this year, or 2025, 26, definitely it will come through. That gives the element of growth. And that's where I think we all, a majority of all the ideation is converging around that. So valuations first, and it's a large cap allocation which is there, fairly steady in terms of performance, and could get an element of growth because they've already booked a significant amount of orders that is a pipeline that is already out there. And I think that's what's playing through in the sector having a revival just now.
Noted. Okay. So buying the valuation, just in the same argument, since we are talking about export-oriented themes, this clarion call that the pain in the chemical space might ease at some point of time started coming in about 6 months ago. We're now starting to see select companies talk about prospects possibly looking better in the second half of the current financial. Agro, the argument is still out there in the open. I would love to understand again, how do you think about chemicals, considering that the Chinese situation probably still is not completely clear about whether they will dump, whether they won't, and what is the kind of growth that will come in there. So how does one approach chemicals?
So I don't have a crystal ball into this sector, but everyone loves to bottom fish at this point in time, and that's what or bottom fish in troubled waters at this point in time. And I think I mean we are also got a couple of businesses on the radar, but I'm not too sure that we are anywhere at the bottom of the cycle yet. Right? And it probably take another 1 year before things become significantly clear, especially in the agrochemical space. There is reportedly some plant closures coming up in a couple of countries that are there, which is aiding this conversation around the segment of the market bottoming and volumes will emerge. If that happens, yes, it will. But will they demonstrate returns like we've had in the previous cycle? Very unlikely. At best, they will just participate with the rest of the market, and that's my sense. So there is no significant valuation comfort despite this industry not doing very well. Volumes and capacity, I think both of them will exist for this industry. What it may not have, at least in the near term, is any real pricing power. Or I'm not very sure that prices are going to bounce back compared to where we left them off about 2 years back. So I think that's where it is. I mean, you will get moderated returns, but nothing significantly close to what you got in the previous cycle.
So you investing in this purely from a perspective that the downsides might be limited, Kenneth, or is your choice of stocks differentiated chemical businesses which might do well even if the larger bucket doesn't?
So we're at a juncture in the marketplace where everything is fairly discovered and where everything is fairly priced. Right. We're just looking at opportunities which have not done well till now or have moved sideways and probably finishing either a time correction or a price correction. And then the fundamentals of the business. Like I said, the time correction and the price correction is happening in a number of sectors, but the fundamentals are not really improving or like I said, it would improve in 6 months, in 1 year, or in 2 years, in probably 2 years. But this may just be a place where you could allocate some capital to and watch it and continue to increase your exposure over the next couple of quarters or a year or two.
Kenneth, I want to wrap up with talking about a sector where you were amongst the early identifiers, and that is real estate. A lot of conversation about whether we are in the midst of the cycle or towards the end of the cycle, so on and so forth. you were invested. I don't know if you still are, but what's the argument around real estate?
I think it's already done quite a bit. And the way companies have access to capital today, which is basically raising a lot of equity, completely changes the fundamentals of the business right now. Because whenever businesses like this get incremental amount of capital, there is usually capital deployment into creating a land bank. Okay, so we're in the very early stages of an industry cycle actually topping out. I said it's a very early stage of an industry cycle actually topping out. Because if the industry, I think, has already raised about 15,000 odd crores or some such number that is there. Uh, a very large part of this number is now going to buy new land banks that are there, which was not the business model that has brought the industry to this level or to this juncture. So this is a flipping point wherein when you have new inventory coming in, the new inventory at new land bank prices, there is a price rise in real estate that will come through. That price rise will temper sales for a while. Okay, so volume will give way to price. In short, I think we're in the early stages of this industry topping out. While companies are getting capital today, the leverage cycle in some of these companies will start maybe in a year's time, which means more capital comes into play, and then we'll have to take it from there. But the best, I think, is behind us.
Best is behind us. Okay. Point well noted. Kenneth, as always, lovely talking to you. Out of time completely here, but great having some of your thoughts here, and look forward to talk to you more often.
Thank you. Have a great day.
That's the view from Kenneth Andrade of Bullish Capital. And with that, it's a wrap on this edition of The Talking Point. Thanks so much for tuning in.